It's 9:51, 31st of May 2012. It's a really short video on all the possible entry points for a trade that's based on a technical reason or a trading reason. So, very quickly, you can buy support with no signal otherwise. And I define market structure as that which is defined by horizontal lines, be it support and resistance, pivots, or fib levels. The fourth one is diagonal lines. I don't consider moving averages market structure. So, number one, you just buy support. Or you can do that with a RSI divergence in that time frame or the inferior time frame. That increases the probability. Of course, you can sell resistance. So although there's 13 trades here, there's actually 26 because everything has the opposite. You can sell the break of support. When that support goes back to get retested, it's the classic trade. It acts as resistance and we sell it. Then the market moves down and makes a reversal and retraces. Then you have the option of selling at one of the fib levels, be it the 50 or the 61.8%. That's the most probable. Now, there could be a bearish RSI divergence there at the test of the level, and if there isn't, you could check the inferior time frame. So I would call that the classic fib trade. So wherever you see red, that has an RSI signal, and black it doesn't. So at the classic trade, there could be a bearish RSI divergence in that current time frame. So if we're looking at the 5-minute chart, there could be one. But if there isn't, the signal could be seen in the 1-minute chart. So you always got to check the inferior time frame. And the 1-minute chart is only used for RSI divergence. So then the market pushes lower. Now, the same thing happens on a diagonal dimension. So one of the trades is just buying the day low, but if it's not on a level, this trend line doesn't exist. So it would just look like, well, the green line wouldn't be there. So if I move the green line, it's just buying day low, but there's no reason to do that. That's just guessing. So more than often, you could buy a day low that's not on a level with a bullish RSI divergence. So I call it number 9. That's the naked RSI reversal. Often, I'm making videos that don't talk. Often, you connect 2 points. So you could buy the third test of the new trend line support, and if there's a bullish divergence in that time frame, great, it makes it more probable. But you could go to the inferior time frame, and that would be a signal that a third test where we could expect support is going to occur. You could sell the breakout of trendline support. The best way to do that is to wait for the first candle to close below the trend line, get short 1 tick below that first candle, and your stop goes above the recent high. Now, if this here, okay, this is a double top in price between here and here. If there was a bearish RSI divergence, then it would increase the probability of selling the break of a trendline support, because at the top of the day we have a signal that suggests trend reversal. The break of the trendline support indicates that the bears have taken control and the bulls have lost. So we just have a reversal. Then your next short is at a trendline retracement. And as I said, if a market moves fast and there's no other reason to take a sell, it's called the fast money, I guess, trade. So you just hit sell at market for no other reason than momentum. So I call that 8. And then 9 is just, it's not on a level, so the only signal is an indication in a momentum oscillator, which would be a divergence, a bullish divergence. So we have a signal for a possible price reversal, but it's not occurring where you could expect it, so it's a low probability. Now, I think, it's my idea, that there's 4 types of price reversals. There's a double bottom. So first of all, there's three signals in RSI. So this is just price, but we've got to consider RSI. So if I do a duplicate of this, and you've got to imagine this is the indicator. So RSI will follow price, which is the normal pattern. RSI in this case could diverge, so RSI could be going up and price is flat, and there could be a hidden divergence, but that's unlikely in a double bottom. So the other reversal is an RSI reversal on a trend line. So again, if the green is the indicator for RSI, and we're overlooking that this price line down is choppy, so there's zigzagging kind of price action. Now, the normal pattern would be price, so it would be price going down, RSI going down. That's the normal pattern. The next one is the weak signal, then the strong signal. So the weak signal would be RSI flat, which would be up to right here when the price reversal occurs. That's the weak signal. And the strong signal is price going down and RSI going up. The next reversal is just your basic RSI reversal on a horizontal level. And the strongest signal obviously is when price goes down and RSI goes up. But the weaker signal is when price is going down and RSI stays flat. Now there's no predictive value when price is going down and RSI is going down. That offers no predictive value. And the last type of reversal is the highest probability reversal. It's what I call a cluster strategy. It generates a day low outside the range or inside the range. It doesn't matter in terms of an inside day. But it's on a support level and the junction of a trendline support. And the best signal for RSI is price going down, RSI going up. So the strategy is like that. But of course you could have RSI flat. And the lowest probability reversal would be support at confluence of horizontal level and trend line, and there's no signal in RSI. So RSI is going down as price goes down. And I believe that all these price reversals can be ranked because basically this is number 11. It's a basic RSI. No, number 12 is a basic RSI reversal. This is a basic RSI reversal. The fib trade number 5 is a basic RSI reversal. Obviously number 7 is just number 11. It's just a RSI reversal on a trend line. Number 9 is just an RSI divergence. It's a naked signal. And number 6 is just, I call that a classic trend trade. It's just, and of course, if a day low ends outside the range and with a bullish RSI divergence, then it's a signal for trend reversal. We have a new trend by connecting 2 points. So the third point has the expectation of support, and that makes it higher probability. So that's just a short video, as short as I can make it, on the types of price reversals and where they're found. So basically there's 13 possible entry points into a trade, and I challenge anyone with a video reply to find any other technical reason why you would enter into a trade, bearing in mind that there's 26 of these. So I think that's intuitive, it's logical, and of course I'm using RSI as a technical signal. So a trading strategy has to be market structure combined with at least one technical signal, and I use RSI. It could be CCI, could be MACD, it could be price momentum, which is another momentum oscillator. But my research shows that when RSI divergence is more than 5%, it's a leading indicator for a price reversal. So for example, with the weak signal, if I show you with, I'll just change the color of this line. So I'm going to make it red for RSI, and green is the normal pattern. So with the normal pattern, obviously when RSI is where expected, there's no signal. And when it's diverging, the difference between the RSI peaks between before and after, if that's more than 5%, it's a leading indicator for a price reversal. So in a downtrend, for example, where RSI should be going down, then you can see that the strongest signal is, it's not when RSI is flat, it has to be when RSI is truly diverging. So if I draw another line, so the first signal is RSI flat, and the second signal is RSI is up. So you can see the difference between where RSI is meant to be and where it ends up is the biggest divergence, and that's the strongest signal. So the classic divergences are the weakest signals, and I don't use RSI flat. So when price is going down and RSI is flat, I don't consider that I don't consider that a valid signal. That's it.